Morning. So markets are fighting their way through a quad 3, quad 4 type scenario. In other words, markets kind of are in the midst of this tug of war with respect to a quad 3 stagflationary expectation or a quad 4 deflationary expectation. And I know it may seem weird that the market's fighting out what could be no growth with inflation or no growth and no inflation, or in other words, deflation. But it is what it is. I've learned over the years not to ask why, just to simply follow the signals, follow the math, and keep moving and adjust as according and as needed. So that being said, we know that we're in one of those two quadrants, 3 or 4, and we know that in that particular circumstance, the things that work the best and the most are longer dated treasuries, gold, and if it's quad 3, some commodities. If it's quad 4, long the dollar. If it's quad 3, short the dollar. On Monday, we had a quad 4 day. On Tuesday, so far today, we've got a quad 3 day. Okay, fine. Or Wednesday today. So Tuesday and Wednesday, we've had these quad 3 days, and that's fine. So that being said, what I wanted to do is just explain some of the movements that are taking place with respect to the risk management process in terms of where we're at. I've commented before on these videos and certainly on my radio shows that that it really is all about the U.S. dollar, and that if you get the dollar right, everything else will work out in time and space. And so we have today a situation where the U.S. dollar is extremely overbought, meaning that it would not take much for the U.S. dollar to really have a drop from here. And we'd expect the drop in the U.S. dollar to get down to about 92.69. It's at about 94.30 this morning. So in the currency space, that's a pretty big move. And there's a decent opportunity to make money as that dollar drops. And so if your account is such in terms of the risk spectrum to allow shorting an asset, we're moving towards shorting the U.S. dollar in anticipation that it drops. Probably the hardest thing for most people to understand in terms of the methodology that we employ is that we just don't simply follow old Wall Street technical aspects, right? We don't follow moving averages. When I use the term trade resistance or trade support, it really has nothing to do with traditional old Wall Street technical aspects. It has everything to do with the math behind what's happening in the market. And unfortunately, old Wall Street technology, as it relates to utilizing technical analysis, simply doesn't employ volatility as one of the main measurement spectrums for identifying whether an asset should be bought or sold, or whether an asset is overbought or oversold. So in our space, we use price, volume, and volatility, with volatility being the lead component in terms of calculating what's happening with markets, what's happening with pieces within the market, and then of course, in terms of utilizing our A/B test, it's A, what quadrant are we in terms of the movement of the economic sine curve, and then test B, what's happening with the technical signal, technical specifically related to the math of price, volume, volatility. And all that being said, right now we know that the US dollar is overbought. We know that the technical signal is currently suggesting that the dollar could very easily go back to that 92.60, 92.70 range, which when that happens, because there are extremely heavy inverse correlations in stocks, in gold, in commodities, when the dollar goes down, all those other assets go up. When the dollar goes up, all those other assets go down. So this morning, on Wednesday, here we are, September the 23rd, at about 10 a.m., markets, as it relates to stock markets, are in the red. Gold is currently down. Commodity space, for the most part, is currently down. Well, that's because the dollar's up. As soon as you see that dollar reverse, you're going to see these asset classes move up much more heavily. And so therefore, we're positioning ourselves to take advantage of that. I'm not getting really much exposure in terms of U.S. equities at this point, just because VIX, which is U.S. volatility measurement, is still north of 26. 26 is that delineation mark, that line in the sand. And when a market, specifically related to where the economy is in a tug of war between one quadrant and another, you're going to run into a situation where that VIX is in an oscillating mode between, at least right now, roughly 24 and 30. So if we see VIX pop back up to 30, I'll probably gross up some of our equity longs, at least the equities that make sense in either a quad 3 or a quad 4, which typically is utilities and REITs. Gold miners, of course, can work well in that space. Right now, because we're working through what appears to be still quad 3, then we're going to gross up some commodity expectations, like exposure to the ag complex via corn, exposure to rare earths via REMX is the symbol on that one. And of course, we're buying gold. So we're grossing gold up considerably today to get our basis down. We're considering or continuing to gross up our long treasury exposure when interest rates on the 10-year treasury get up to about that 0.7% range, and we'll just continue to follow the technical signals as it relates to price, volume, and volatility. But that being said, I certainly expect the dollar to start falling. If the dollar starts falling, then we end up in a situation where, as I said, all these asset classes go up. There's a negative 0.95, which is a 95% negative correlation currently with U.S. equities and the dollar. There's about the same as it relates to the commodity complex and to gold. So as soon as the dollar reverses and goes down, you can see why those asset classes would move up. And when they do, we'll take the profits. We'll move out of those asset classes and then make some adjustments and continue moving out here. So at any rate, as you know, we've risk managed through this roughly 12% or so decline in the NASDAQ. We'll continue to do so, minimizing any kind of drawdown as best as humanly possible, taking advantage of what we believe to be extremely oversold assets like gold, like some of the commodities, potentially getting towards that in treasuries, and then we'll take some profits when the dollar gets down towards that low end once it reverses. So that being said, that's what we're doing. Just wanted to give you a quick update, and of course, as always, if you have any questions, give me a call, 608-354-1977. Direct email, chris@careformywealth.com. And as I said, one of the hardest things for most people to get their head around if they've had experience on Wall Street is when I hear or when I use the terms support and resistance, it just doesn't relate to the specific old wall technology or the old wall exposure to technical analysis, I should say. This doesn't mean we don't use technical analysis. It just means that we have to factor in volatility in everything that we do. And the only way to do that is, through the calculus of the market, and that's by calculating price, volume, volatility. So as VIX moves up towards 30, probably would create some long exposure in some equities. As it pulls back down to 24, we would unwind them, and just continue to work within that realm. Because as I said, there's kind of that tug of war that's going on right now between the two economic spectrums. So any questions, please give me a call, send me an email. No such thing as a silly question. Always happy to help you. Always thankful to work for you. And with that, hope you have an amazing day.